Saving. Saving is the starting point of multiplying money. It means setting aside a portion of income before spending it on daily life. The idea became widely discussed in early 20th century personal finance books, where writers encouraged people to pay themselves first. What makes saving important is not the size of the amount, but the habit itself. Small amounts placed aside consistently become the first pool of capital a person can use to invest. Without saved money, no financial growth strategy can truly begin. Budgeting. Budgeting is the practice of organizing income and expenses so that money is directed with intention. The concept became more common as household finance guides appeared during the 20th century, helping families manage wages during uncertain economic periods. A budget reveals where money flows each month and where adjustments can be made. By controlling spending and ensuring that some income remains available to save and invest, budgeting creates the structure that allows wealth to gradually grow. Investing. Investing is the act of placing money into assets that have the potential to increase in value over time. Modern investing expanded during the rise of public stock markets in the 19th and 20th centuries when ordinary individuals began to buy shares of companies. What distinguishes investing from simple saving is that money is actively working inside economic systems. Companies grow, markets expand, and productive assets generate value. Over long periods, this process allows invested money to grow beyond the original amount. Compound interest. Compound interest is the process in which money generates earnings, and those earnings begin to generate their own earnings. The principle was already understood centuries ago, but it became widely explained in modern finance education because of its powerful long-term effect. When interest is reinvested instead of withdrawn, growth accelerates, slowly at first, and then faster over time. This compounding effect is one of the main mechanisms through which small investments can become significant wealth across many years. Diversification. Diversification means spreading money across different types of investments rather than concentrating everything in one place. The idea developed strongly during the 20th century as financial research showed that combining different assets can reduce overall risk. Stocks, bonds, real estate, and other investments respond differently to economic changes. By distributing capital across several areas, investors reduce the chance that a single problem will erase their progress. Long-term investing. Long-term investing focuses on holding assets for many years instead of constantly buying and selling. This philosophy became popular when researchers studying market history noticed that patient investors often achieved stronger results than frequent traders. Markets naturally move up and down in the short term, but productive businesses and growing economies tend to expand over decades. Time allows investments to mature, compound returns, and recover from temporary downturns. Income growth refers to increasing the amount of money a person earns over time. Throughout economic history, individuals who improved their skills, built businesses, or advanced in their professions were able to accelerate their financial progress. Higher income expands the amount available for saving and investing. When income grows and expenses remain controlled, the difference can be directed toward investments that multiply financial resources. Reinvestment. Reinvestment is the decision to place profits back into investments rather than spending them immediately. This approach has long been used by businesses and investors who seek steady expansion. When dividends, interest payments, or other returns are reinvested, the investment base becomes larger. Over time, this continuous cycle allows wealth to grow layer by layer, strengthening the compounding effect that drives long-term financial multiplication.